Do you ever feel like you have absolutely no idea what you're doing in the crypto market? Do you find yourself constantly buying the top and selling the dip? If you answered yes to both of those questions, then I'm afraid you have all the symptoms of one of cryptocurrency's deadliest diseases, technical analysis deficiency syndrome. If this condition is left untreated, it could result in an unprecedented loss of cryptocurrency gains, potentially condemning you to a life as a wage slave. Thankfully, a cure does exist, and I just so happen to be well versed in the ancient teachings of technical trading, which constitutes this cure. Today, I'll be passing some of these lessons on to you so you can overcome this chronic disease, protect your profits, and achieve the financial freedom you seek. Before we head to the trading floor, I need to hit my circuit breaker. While I may have the knowledge, wisdom, and perhaps charisma required to be a financial advisor, I'm afraid that I am not a financial advisor, and nothing in this video is financial or investment advice. I should also note that I'm not a doctor either, and technical analysis deficiency syndrome isn't actually a real disease, at least not yet. Now, if this is your first time stumbling across the Coin Bureau, I'd like to welcome you to the channel. Guy's the name and crypto's the game. Crypto news and coin reviews are just a couple of the topics I cover on the daily. So if crypto is part of your daily hustle, then consider subscribing to the channel. Remember to ping that notification bell to make sure my next video doesn't get lost in the YouTube algorithm. And in case you hadn't already noticed, I've left a few timestamps below that you can use to skip to the sections that seduce you the most. You can read a short summary of each section in the description to help you decide where you want to go, but I would love it if you tagged along for the whole journey. On that note, it's about time we got going. So, let's cure your crypto market disease. I want to start by letting you know that this video is technically the third installment in my series on technical analysis trading. I strongly recommend watching the others first if you haven't already, as you'll need some of that knowledge to fully understand today's TA topics. Links to part 1 and 2 are in the description. Now, the first TA topic I want to tackle today is trading timeframes. When you're analyzing the price of any given cryptocurrency by drawing chart patterns or using technical indicators, what you see can change significantly depending on the time frame you've selected. Most cryptocurrency exchanges offer over a dozen timeframes that range from 1 month to 1 minute. Some exchanges, like FTX's Serum Dex, are hoping to make it possible to trade on timeframes that are in the milliseconds. Traders are categorized based on the timeframes they use. Swing traders focus on timeframes that are 1 day or longer. Day traders focus on hourly timeframes, and scalp traders focus on minute-to-minute timeframes. Scalp trading is considered to be the riskiest because short timeframes give you mixed signals when it comes to price patterns. This tends to lead to overtrading, which can quickly drain your trading portfolio. That said, there are some traders who believe that you can effectively trade the 1 minute timeframe using the 1 second timeframe offered by TradingView. I'll leave a link to a video that explains this strategy in the description if you think you're experienced enough for it. When it comes to swing trading and day trading, there is one simple rule of thumb to follow. The longer the time frame, the stronger the trend. As you can see here, when I look at the daily chart for Bitcoin with the EMA indicators enabled, it looks like we've fallen below our first 2 levels of support, specifically the 7-day EMA and the 25-day EMA. Bitcoin is clearly in a downward trend, which suggests that it's about to crash hard. However, when I switch to the weekly chart, you can see that we are still sitting above the 25-week EMA, which is 30K. And the monthly chart shows that we are a ways from any of the monthly EMAs, the highest of which is showing a price of 17K. The monthly timeframe also reveals that Bitcoin is in fact still in a strong uptrend. What this means is that Bitcoin has some strong zones of support if the price were to fall, and it seems more likely that it will continue to go up in the long term. While that's certainly good news for swing traders and hodlers, I reckon most of you are here because you want to do some day trading. So, let's go back to that daily chart. Once again, we see that scary downtrend, along with some support at the 30k level. There also seems to be some support at the 29k level, some support at 26k, and a whole bunch of support at 23k. To the upside, we seem to have some resistance at 33k, 35.5k, and just under 38k. Now, since we've been trading sideways for a few days, it's hard to tell what the price is going to do next. But if the day was to close below 30k, this would confirm we are in a downtrend. Conversely, if it closed above 33k, this would signal an uptrend. When the trend becomes clear, you can dig down to the 4-hour and 1-hour timeframes and trade based off the daily trend, the daily support and resistance levels, and along with any other zones of opportunity you find using technical indicators. If you're wondering how you could possibly stand to benefit from the price of Bitcoin going down, the answer is leverage trading. In plain English, leverage trading is when you trade with borrowed money. Trading with leverage is how experienced traders make money and how inexperienced traders lose money and get wrecked. In leverage trading, you can supercharge your profits on a cryptocurrency when it increases in value by going long, and even profit when the price crashes by going short. Most cryptocurrency exchanges offer some sort of leverage trading via their futures markets and usually offer anywhere between 1 to 100x leverage with stablecoin settled contracts, meaning you're trading a stablecoin like USDT instead of actual Bitcoin. If you're wondering how exactly leverage trading works, here is a simple example. Recall the previous day trading timeframes I showed you. Suppose you're certain that Bitcoin's price is going to drop from 30k to 29k and want to profit from this little correction. What you could do is enter a short position using USDT. If you short with 1x leverage, then you're just using the USDT you own. You aren't borrowing any money. This means that if you shorted Bitcoin with 1x leverage and 3,000 USDT, you would make 100 USDT in profit if you close your position when the price of Bitcoin drops from 30k to 29k. Not bad, right? Well, if you shorted Bitcoin with 100x leverage, you would make 10,000 USDT from that 1k drop in price, 100x more than that 100 USDT. Here's the scary part. If Bitcoin was to go above 30k by just $30, you would lose your $3,000 like that. Why? Because you're trading with 100x leverage and 30 times 100 is 3k. If the exchange doesn't liquidate your position, then they would be in the negative because they're the ones lending you the money. Given that Bitcoin's price can fluctuate by hundreds of dollars a second, you are almost guaranteed to lose your money when trading with more than a few times leverage. This is why traders will set something called a stop loss, which would automatically close their short position if Bitcoin's price went over 30k by, say, $5. That doesn't sound like much, but that's a $500 loss on that initial 3k. As you can hopefully tell, leverage trading is extremely risky. It's a point that I wish more people understood. If you plan on doing some leverage trading, I insist that you better educate yourself by watching my video about it by popping open a new tab using that link in the top right. Warnings aside, measured leverage trading can come in handy when the crypto market is in a free fall, and there are safer ways to do leverage trading than using a futures exchange. In May of 2020, Binance introduced leverage tokens to its spot market exchange. Binance leverage tokens are those up and down tokens you see when you're searching through trading pairs against USDT for major cryptos on Binance. The amount of leverage you get from these tokens fluctuates between 1.25x and 4x depending on market conditions. In contrast to leverage trading, you technically cannot be liquidated when you hold Binance's leverage tokens. Instead, the value of the leverage token simply rises or falls depending on the type of token it is. Using Aave as an example, you can see that the Aave Up token, which represents a long position on Aave, has gone up by 11.3% in the past 24 hours, whereas Aave has only gone up by 6.6%, which is almost a 2x leveraged position. By contrast, the Aave Down has dropped by over 22%, which corresponds to a leveraged position of roughly 3.5x. If you're wondering why the actual dollar price of Aave Up and Aave Down are so different, I recommend you read up about Binance's leverage tokens using the article I'll leave below. If you want to trade these leveraged tokens on Binance, signing up with my link in the description will get you a 20% discount on trading fees. Of course, if you don't want that 20% discount, then you can totally ignore the link and pay the full fees. The main takeaway here is that Binance leveraged tokens allow you to long and short major cryptocurrencies with significantly less risk than leverage trading. Take a guess which leveraged token I've been trading in recent weeks. Now that you know how to maximize your profits using leverage, I reckon it's about time I told you how to detect major moves in the crypto market before they happen. The key to spotting a breakout to the upside or a collapse to the downside is being familiar with the most common price patterns and indicators. Again, you can refer to my first 2 videos about technical analysis to learn about these. Using Bitcoin's recent price action as an example, it's quite obvious that we are in a descending triangle. As you hopefully know already, descending triangles tend to break to the downside. How low could the price fall? Well, there are a few critical zones to watch. The first is 20k, which is how low we should drop according to the descending triangle pattern. This also just so happens to be the support level provided by the 200-day moving average. Remember that there's also support at 26k and 23k, so if we do touch down to 20k, we're going to have 2 stops on the way down and won't be in total freefall. These are the zones where you could set stop losses on short positions or even accumulate some BTC if you're in it for the long haul. Okay, so how do we know when the downwards trend has actually begun? The secret is trading volume. Notice that the selling volume has been decreasing in recent days. This suggests to me that people are not too eager to part ways with their Bitcoin, and we probably won't be moving too much lower. However, if I see that this selling volume increases and we close the day significantly below that triangle formation, this would confirm a breakout to the downside. Now, even though descending triangles tend to break to the downside, given that we're in a strong long-term bullish trend on the monthly chart, there is a chance that this descending triangle could break to the upside. To confirm a breakout to the upside on this Bitcoin chart, we would need to see a daily close above the sloping edge of the triangle, which is around 33k, with lots of volume. This conveniently corresponds to the 33k resistance level I drew earlier. In terms of estimating how high we can go, the same rules apply as before. The triangle pattern alone suggests that we could go back to Bitcoin's all-time highs in the low 40Ks. Again, if we do reach that price, we are likely to have a couple of stops along the way at 35.5k and 38k. This means that you could go long and set a stop order around those price ranges, or take some fiat profits if that's what you're into. There's just one last thing to figure out, and that's where the next levels of resistance could be when Bitcoin pushes past its previous all-time high of 42k. While price patterns and technical indicators go a long way in day-to-day trading, it's a whole different ballgame when prices start to go parabolic. That's because you're in uncharted territory, and the absence of any resistance in front of an upwards price trend means there is no way of knowing what the next high is going to be. Take Theta, for example. The price of the token went from about 70 cents in early December 2020 to nearly $2.50 in early January this year. I had a feeling it would see explosive growth because of its absence of any previous resistance as a newer altcoin. You can watch my video about Theta by clicking up in the top right of the screen. Now, I reckon you could have predicted Theta's January top using the Fibonacci indicator, which is how many crypto traders guesstimate the next resistance levels for Bitcoin when it pushes past previous all-time highs. As I hope you'll already know, when you're trying to predict how high the price could go using the Fibonacci indicator, you draw it using the swing high and the swing low as reference. In this case, the swing high I'm using is Bitcoin's previous all-time high, and the swing low is the lowest price Bitcoin has seen in this 4-year cycle. Based on this, the next area where we could see some resistance is around 46.5k. The next level after that would be around 63k and finally 73k. It's worth pointing out that the strong 30k support we've seen recently is also reflected in the Fibonacci indicator. In fact, it's quite common for prices to bounce between the critical price zones noted by the indicator, and I imagine we will see some similar sideways action in the next two zones as well. Besides the Fibonacci indicator, there are also a few key psychological price levels to keep in mind, namely the 100K mark, which is where I think many people are going to take some profits. The smarter traders in the crowd will probably do something akin to front running. Now this is where you sell your Bitcoin a few hundred or even a few $1,000s below a key resistance level. It is a clever tactic, but be aware that it doesn't always work, and many of these traders realize soon afterwards that they sold way too early. Now when the time comes, it will be up to you to use your judgment. I believe in you. And that concludes episode 3 of the Coin Bureau course on technical analysis. Now, in retrospect, I probably should have covered the use of timeframes in trading earlier on. It is something that I saw many of you asking about in the comment sections of my previous 2 TA videos, and I hope that you now have a firm understanding of how to use these different timeframes. Although my personal preference is to hodl, I do swing trade from time to time. I'm personally not a very big fan of day trading, mainly because it takes a lot more time and practice to get good at, and that's time I'd rather spend making content for you good people. Scalp trading is completely out of the question. It's like a vanilla version of leverage trading, in my opinion. When you mess with leverage, I find it's too easy to get carried away, and in almost every case, the risk outweighs the reward because you will get wrecked more often than not, even with stop losses. If you insist on getting as much profit out of this market as you can, leverage tokens are a great alternative. As I mentioned in my first video about technical analysis, spotting a new price trend boils down to trading volume. It is that crucial piece of context that's often ignored when the price of Bitcoin starts to fall. Whenever you feel the FUD coming on, take a moment to exercise that TA muscle and see if there really is cause for concern. Pulling out that Fibonacci indicator from time to time is also a nice way of reminding you of the bigger picture. Cryptocurrency still has a really long way to go as an asset class, and even though the road is not straight, I am quite confident that it will become the most valuable market on the planet. Besides the derivatives market, of course. That is some next level shit. If you enjoyed this video, then destroy that like button to let the world know. If that subscribe button is red, it means you haven't pressed it yet. Go on. And ping the notification bell while you're at it. If there are any other topics related to technical analysis that you'd like me to cover, well, please leave me a comment. I love reading what you guys have to say, and recently the comment section has been pretty dank, to say the least. If you're wondering what I'm referring to, it's probably because you aren't following me on Twitter or Instagram. Well, you can do that by clicking my socials link in the video description. There, you'll also find a link to the Coin Bureau Insider Telegram channel, where I share daily market insights and analyses. It's like a daily digest version of my weekly newsletter, where I do all of that, plus reveal my personal cryptocurrency portfolio. So, if you want to look like a boss while reading my weekly newsletter, well then, head on over to the Coin Bureau merch store and pick up some gear. All proceeds go towards supporting the channel. Links to my weekly newsletter and merch store are also in the video description. That's all I have to say for today, ladies and gents. Thank you so much for watching. Keep stacking those sats and stay glued to the tube.